If you are in the market to buy a condo, or if you are a real estate agent that works with condos a lot, then this is for you. For those of you guys that don't know me, my name is John Cams. I am a mortgage loan officer with Rate Mortgage. I have been helping people buy, sell, and refinance homes for going on 25 years. This presentation is going to be going over very important condo guidelines and updates that are going to impact, number one, your market as a real estate agent, or number two, if you are a buyer, your ability to potentially buy a condo. So let's go ahead and get into this. First things first, we are going to go over what are the best practices if you are looking to buy a condo, or if you are a real estate agent and you are going to help somebody buy a condo, or if you're a real estate agent and you are going to help somebody sell a condo. So what should you confirm? If you have a listing in a condo, or you are a potential buyer purchasing a condo unit, what do you need to be aware of? What do you need to confirm? First things first, you need to verify the property type of the subject. Is it a condo, or is it a PUD, also known as a townhome? I've had multiple times in my career where I get a property that I am being told is a townhome, also known as a PUD, but actually it is legally a condo. So if you are buying what you perceive to be a townhome, you need to verify the actual legal description, because if it is a condo, the condo guidelines are much more stringent than a PUD, also known as a townhome. Second, you need to provide the name of the association, the city, the state, and the zip. Oftentimes we get the address of the condo. We can't really do much with the address of the condo. We can look it up to see if we can find the name of the association, but nothing is better than the name of the association with the city, the state, and the zip. And this is number three, going to allow us to look in the rate company internal databases. We are a massive mortgage lender. We're national. There's a good chance we have maybe already done a loan in the building that you're buying, which can definitely help us. Fourth, you are going to need to determine whether or not the FHA project is FHA approved. It is most likely not, but if it is FHA approved, then that can definitely help if you are trying to obtain FHA financing in the building. If it's not, we are going to need to do a one-off approval. So it is good to know if it is FHA approved. Also, what is great to know, number five, is the status on the VA project list. So another way of saying that is if you could find out if the project is VA approved. Six, is it Fannie Mae approved, and is it on the ineligible list? Most condo associations will know if they are on the ineligible list. This is basically a condo that Fannie Mae is already deemed ineligible. So you could save yourself a lot of time and heartache by knowing that up front. And then the Freddie Mac project database could have information for the project as well. But ultimately, guys, we will be able to check this for you, but we do need the name of the association, as well as the city, the state, and the zip. Now, once you have that information, what is next? What is next is that you get us the most vital documents to review as soon in the loan process as possible. These documents are the condo questionnaire, the current HOA budget, the HOA master insurance policy, and the resale disclosure. Now, what's great, guys, the seller may have access to a unit owner portal, and these portals may have a majority of the project documents aside from a completed questionnaire. And this can be very helpful in listing a condo project. It allows lenders to have as much information about the project as possible when determining approval. If you're a real estate agent, you can look like a rock star if you find this out up front on a condo that you are listing, especially if there is a potential issue. As a realtor or a buyer, how can you help this process? The condo underwriting process can become challenging, and the way that you can help is to help my loan processing team get the questionnaire, budget, and the master insurance documents as quickly as possible. And as a realtor, you need to set proper expectations. Obtaining all the documentation can be a lengthy and complicated process. For example, FHA, VA loans in condos that are not approved can typically require a 45-day closing or more. And here is a hot topic that we're going to go over in depth, guys, that has been making a lot of condos non-warrantable or not qualified to get financing on, and it is critical repairs and special assessments. And specifically, guys, what happened was the Surfside condo collapse that has completely reshaped condo guidelines. So let's go over how the Surfside condo collapse has reshaped condo guidelines. So after this condo collapse, what happened? Well, October 2021, Fannie Mae and Freddie Mac published temporary guidelines in response. And what's crazy about this, guys, is they made these guideline changes, but they technically did not go into effect until nearly 2 years later. So September 18th, 2023, the agencies published permanent guidelines for an in-depth review of all condo projects. Lenders are now required to obtain and review many more project documents for eligibility. Specifically, all mechanical and or structural engineers reports or inspections within the last 3 years must be provided to the lender for review. All proposed and active special assessments must be disclosed and reviewed, and code violations within a project will now impact project eligibility. And just to recap what additional docs are needed, completed condo questionnaires, lender-specific forms, or the agency 1076 forms, budgets and financial documents. This includes reserve studies, inspections and engineer reports completed within the last 3 years, HOA meetings minutes for the last 6 to 12 months, and special assessment information letters, active and proposed. And like I said, critical repairs are a big hot topic right now, and why a lot of condo buildings are deemed non-warrantable or ineligible for financing. So critical repairs are defined as repairs and requirements that significantly impact the safety, soundness, structural integrity, or habitability of the project's building and or that impact the unit values, financial viability, or marketability of the project. These include material deficiencies which left uncorrected have the potential to result in or contribute to critical element or system failure within 1 year. Any mold, water intrusions, or potentially damaging leaks to the project's buildings that have not been repaired. Advanced physical deterioration, any project that failed to pass state, county, or other jurisdictional mandatory inspections and or certifications specific to structural soundness, safety, or habitability, or any unfunded repairs costing more than $10,000 per unit that should be undertaken within the next 12 months. This does not include repairs made by the unit owner or repairs funded through a special assessment. Example of some items to consider include but are not limited to seawalls, elevators, waterproofing, stairwells, balconies, foundation, electrical systems, plumbing, water intrusion, parking structures, or other load-bearing structures. Now, what about preventative/routine repairs? Not all repairs are considered critical. Lenders will review the status and progress of any ongoing repairs to determine compliance with guidelines. Preventative in nature or part of the normal capital replacements, example, focused on keeping the project fully functioning and serviceable, accomplished within the project's normal operating budget or through special assessments that are within the guidelines. Guys, there's a big gray area here, but generally speaking, preventative/routine repairs will not stand in the way. All right, so now that we've talked about number one, what you can do to help us and what you need to know whether or not you may have an issue, and went over critical repairs, which is a big hot topic affecting condo warrantability and financeability. The next thing is condo insurance, which is often standing in the way of you buying a condo or obtaining financing on a condo. So what is happening? Well, HOAs, developers, and condo projects are increasing insurance deductibles throughout the nation due to inflation, rising costs of goods and services, natural disasters, average age of condo buildings, and the Florida condo collapse. And so here are some very interesting statistics based on a survey of over 10,000 condo projects. 91% of condo HOAs confirmed property and casualty insurance premiums increased at the last renewal. I know mine did. 24% had higher deductibles forced by the insurer. 50% increased individual assessments to cover the increase. 43% used other methods such as increasing deductibles, and 7% imposed special assessments to cover these costs. Now, in response to these rising insurance costs, HOAs are trying to find ways to mitigate the higher costs. Insurance policies can show changes in coverage that impact the project's eligibility. So basically, you find out that your insurance is going to skyrocket on your condo, and the association lowers the costs, but doing that can deem the project ineligible because of the insurance. So here are the most common ones we see: higher than 5% deductibles on HOA property insurance policies, co-insurance provisions, actual cash value coverage, most commonly for roofs, reduced property insurance coverage to lower than 100% of the replacement cost value, and limited or reduced coverage for specific perils such as wind, hail. I recently had a condo that I got approved. It had to go non-warrantable, but the reason we could not get financing on it because certain perils were not covered under the current condo association policy. Now, are there options? Unless the HOA brings their policy into compliance with guidelines, financing can be extremely limited. Most investors will follow standard agency guidelines. Aside from brokered lenders, some non-warrantable condo lenders may consider specific ineligible HOA insurance components, but not all. And what do we see most often, guys? What are the most common identified concerns that we have when helping people buy or sell a condo? Litigation. This is very common. All litigation must be reviewed to determine if it would be compliant with guidelines. Litigation related to safety, structural soundness, habitability, or functional use of the project are ineligible, even if the litigation is not formally filed. Pre-litigation activity like mediation or arbitration still must be reviewed under the litigation guidelines. Most common types of litigation is personal injury lawsuits or internal disputes, which would be eligible with confirmation that the HOA insurance carrier is providing the defense, and the HOA insurance policy will likely cover monetary damages should the HOA be found liable or settle. So, guys, I've seen this a lot where you have somebody who has litigation for personal injury and it's small, but unfortunately, the HOA insurance will not provide what we need. Another one would be construction defect litigation is not eligible unless verification that all the defects have been repaired and paid for. One of the other things we see often, guys, is budgets. An HOA budget must be reviewed to verify that the HOA is contributing a minimum of 10% to a reserve account and is balanced. This is required under full review guidelines for attached condos. So we have two examples here where in 2024, this condo association, Holiday Park Condominium, was not putting enough away. And then in 2025, they rectified it. Notice they have a total of 496,827 in assessment income, and they are now putting away 49,749 into reserve allocation. And same with the Ambassador Square Condo Association example here. They are meeting their 10% reserve requirement. Oftentimes, we'll see condos that have a lot in reserves and they think that they only need to be putting 5% away because they have so much in reserves, where that is not going to fly. They are going to require that there is a 10% allocation to the reserves in your budget. Rental concentration can absolutely have an effect on whether or not your condo will be approved for financing. This is one that has actually gotten a little bit more lax. So as long as you are buying a primary and a second home in an established project, then we do not need to verify that 50% of the project is owner occupied. However, if you are buying an investment property or a new construction condo project, we do need to verify that 50% owner occupancy is met. And if it is not met, meaning you are buying an investment property and 70% of the property, 70% of the units are already owned by investors, then that is going to push this into a non-warrantable condo status where you could have issues obtaining financing. Single entity ownership is another thing we see all the time that can definitely affect whether or not you can obtain financing on a condo. No single entity, including developer units, if they are not vacant and listed for sale, can own more than 2 units in a condo with 5 to 20 units. So if you have 5 to 20 units, no single entity can own more than 2 of those units, or greater than 20% with Fannie or 25% with Freddie of the total units in a condo with 21 or more units. So nobody can own, they can own up to 49% if the subject unit is a purchase of one of the single entity owned units and there are no pending or active special assessments. The single entity is the current or on as current on their HOA dues and for the units they own, and the single entity confirms they do not plan on selling units and retaining no more than 20 or 25% with Freddie, or retaining no more than 2 units if the condo is 5 to 20 units. So guys, if any of these factors are present, your condo will be doomed what they call non-warrantable. Non-warrantable means that we cannot take this loan to Fannie Mae or Freddie Mac or FHA or VA. It's basically a fancy way of saying that the condo is not approved for conventional financing. So if the condo is deemed non-warrantable, what are your options? Well, in certain situations, rate mortgage companies, we have non-warrantable lenders that would consider projects that do not meet the agency guidelines. Some of the non-warrantable features allowed are the following: 10% HOA insurance deductibles, so you have more than the allowable 5% insurance deductible. Condotel projects are another one that we can typically work around. Commercial space of up to 50%, single entity ownership, pre-sale requirements for new condos that are less than 50%. Also, we have had success, like I mentioned earlier, with some of the condo insurance hiccups that we see with the new deductibles and rising insurance costs. So if a condo is deemed unwarrantable, or you know it's unwarrantable, what is the process? Well, step one, we would need to review the condo project documents to identify the ineligible characteristics. Why is it non-warrantable? Step two, once the project is fully reviewed, all options for condo financing can be provided. But a side note here, without a loan in process, we would be unable to order documents. Documents will need to be ordered independently and provided for review. So with a loan in process, we can help, but your borrower you as a borrower or as a realtor, your client may incur some fees to get those documents. Thank you guys so much for tuning in. We really appreciate you. If you have any questions, feel free to drop a comment or shoot us direct message if you have a specific condo question or a specific scenario that you're working on. I will say that we are phenomenal with condos. We are based in Chicago, so we deal with condos all the time. If anybody's going to be able to help with a weird condo situation, it's going to be us. So go ahead and drop a direct message. If you drop me direct message if you have a specific question, or drop a comment. We hope you enjoyed the presentation. Make it a great day.